January 1st, 2000, two people retire on the same day with the same amount of money, 1 million each. They both start withdrawing about $50,000 a year, increasing with inflation. Same starting balance, same spending, same retirement date. One of them runs out of money by 2016. The other is sitting on $1.9 million today, nearly double what they started with, after pulling out almost 1.8 million in total withdrawals over 25 years. This isn't a hypothetical, this actually happened. And the only difference between these two retirees was how their portfolio was built. The first retiree put everything into the S&P 500, all stocks, no diversification. On paper that sounds aggressive but reasonable. The S&P has delivered strong long-term average returns. Over 25 years that should be more than enough to support a 5% withdrawal rate. But here's what actually happened. They retired in January 2000, right into the dot-com crash. The market dropped 3 consecutive years, and the whole time they're still withdrawing 50,000 a year because the bills don't stop when the market does. They were selling shares at depressed prices just to fund their lifestyle. Those shares were gone, permanently removed from their portfolio. They never participated in the recovery. And then 2008 hit. The cycle repeated on an even smaller base. By July 2016, the portfolio was empty. 16 years into what was supposed to be a 30-year retirement, done. The second retiree started with the same 1 million on the same day. Same withdrawals, same inflation adjustment, but instead of going all in on stocks, they used a balanced approach, a mix of stocks, bonds, and other asset classes designed to reduce volatility while still generating growth. That portfolio took the same dot-com crash. It took the same 2008 financial crisis. The balanced portfolio lost about 7% in 2002 and 22% in 2008. It wasn't bulletproof, but because the losses were smaller in the early years, the base survived. The withdrawals never ate into it the way they did with the all stock portfolio. There was room to recover, and recover it did. Through 25 years of withdrawals, totaling nearly 1.8 million, that portfolio didn't just survive, it grew from 1 million to 1.9 million. It nearly doubled despite funding an entire retirement along the way. Same starting balance, same spending, same retirement date. One portfolio is at zero, the other is at 1.9 million. And the only variable was portfolio structure. This is what sequence of returns risk looks like in real life, not in a textbook, not in a Monte Carlo simulation, in actual market history with actual dollars. Let me explain why this happens, because it's counterintuitive. When you're accumulating, saving, contributing, building, a bad market is annoying but recoverable. You're buying in at lower prices, you have decades for compounding to work, time is on your side. In retirement, the math reverses. You're no longer adding to the portfolio, you're subtracting from it, and when you subtract from a declining balance, you're locking in losses that can never compound back. It's not just that the market went down, it's that you sold into it. And what you sold is permanently removed from the recovery. That's the mechanism. And it's why the first 5 years of retirement matter more than any other period in your financial life. Think about the all stock retiree in 2000. They started pulling 50,000 from a declining portfolio immediately. After 3 years of losses plus withdrawals, their effective withdrawal rate had climbed from 5% to over 8%, not because they spent more, but because the denominator shrank. And rising withdrawal rate in early retirement is the single strongest predictor of a plan failing. The balanced retiree experienced losses too, but smaller ones. The worst early year decline was 7%, not 22%. By the time 2008 hit, the portfolio had grown enough to absorb it. The sequence still mattered, but the structure softened the impact. That's the lesson. You don't get to choose when the bad years happen, but you do get to choose how exposed you are when they arrive. So here's what I want you to think about. Most people answer the question, am I ready to retire? With the total number. I have 1 million, I have 2 million, I have 5 million. And they assume that if the number is big enough, the plan will work. But you just saw two people with the exact same number retire on the exact same day, and one of them went broke. The number wasn't the problem, the structure was. So let me ask you a few questions. If the market dropped 30% in your first year of retirement, do you know what your portfolio would look like after the drop plus a full year of withdrawals? Not a rough guess, the actual number. Do you know what your effective withdrawal rate would be at that point? Is it 5%? Is it 7%? Is it 9%? Because that number, more than your total balance, is what determines whether your plan survives. Have you modeled your first 5 years against an actual bad sequence? Not an average return assumption, an actual historical stretch like 2000 to 2005 or 2007 to 2012. Because averages hide the thing that actually matters. The all stock retiree had a strong average returns over 25 years, and they still went broke. And do you know how your portfolio is actually structured for the distribution phase? Not how it was built during accumulation, but how it's built for the decade when you're spending from it. Because the allocation that got you here is not necessarily the allocation that protects you once the withdrawals start. And if you've answered no to any of those, that's not a knowledge gap, that's a structural gap. And it's the kind of gap that doesn't show up until the damage is already happening. This is exactly what we build in a retirement strategy session. Not a generic projection, not a Monte Carlo with average returns plugged in. We model your specific portfolio, your specific spending against actual bad sequences so you can see exactly how exposed you are in that window that matters most. You can book a session at secondactplan.com. It's 45 to 60 minutes, planning first, no pressure. You'll walk away knowing whether your plan holds up when the first 5 years don't cooperate, and if it doesn't, exactly what needs to change. Thanks for watching. I'll see you in the next one.